Hello, my friends. Brett Pattison coming at you from the land bountiful, which is also the financial capital of the West, joined by the chairman.
How's it going, Brett?
Also
Spencer?
the land
We,
bountiful. Doing
yeah,
good, Brian. Doing real
good,
good. Good to see you,
good.
chairman. We brought the lefty in from the bullpen today. That's Spencer. Although he's not a lefty, he's a righty.
I'm a righty.
Righty.
I can't do a lot with my left hand.
It's been a while, Spencer, since you've joined us. I'm glad you're here.
Appreciate the invite. I've just been waiting. I've been sitting in front of my computer for 3 months now, just smiling, working on my smile.
I know. I know
Your
you don't have a whole lot going on, so
your
yeah.
location looks a little very mystical, I think, or something.
Home office today. Home
Home
office
office.
today.
Okay, there you go. Good.
Oh, that's good. Thanks for joining us from home. Tell the family
Hey,
hi.
glad,
We
glad, glad I could be here.
we got some important things to discuss today. Three topics, but before we talk about these main topics, I want to address the market as a whole and where we are so far this year. And I'm going to share my screen for those viewing the YouTube can see the charts real time. This is so far this year, S&P 500, that orange line is up 1.3% today. It is Friday, June 20th. Today is what they call triple witching day, which is when index futures, index options, and regular options all expire on the same day. And it is the biggest triple witching day in history of the market. And typically when you have those, you have volatility, which we're seeing today. That's why we've ticked down and the market's up 1.3%. NASDAQ's up so far this year 2.93%. That's a big change from where it was, Spencer, in April. Put on your seatbelt, brother.
Big change from Liberation Day.
Liberation Day. Yeah, you can see on your screen, which is that first part of April. And as we always say, bull markets typically follow the speed of bear markets. Brian, you mentioned that last podcast, and that's what's happened so far this year. That's where we are. Let's take a quick look at interest rates. The 10-year, Spencer, 4.39%. We started the year at 4.58. So we've come down, which we needed to come down more, right? So that's where we are year to date. Any thoughts on the market, Brian, as we head into the summer doldrums, as we have a war in Iran and Israel, as we have tariff deadline July 4th? Should we sell now that the market's back? What should we do, brother?
Yeah, there's always it seems like, I don't know, every time we talk, it seems like there's a lot of uncertainty. I think right now I think there's more uncertainty, but that's just par for the course. I mean, we always have a lot of uncertainty, maybe a little bit more right now with a couple wars going on in the world. We still have concerns of inflation. Interest rates, I think, are very key. Market or investors are paying attention to, you'd mentioned the 10-year treasury. Investors are paying a close attention to that, what's happening there, and the inflation, and just a lot of uncertainty, which is, I think, normal. So just par for the course.
There will always be something to worry about.
Yeah, always. Well, if not, we'll figure something out. We'll find something to worry about.
Yeah. It's interesting because one of the things we wanted to talk about today was one of the greatest investors that's ever lived, Brian, and that's Steve Ballmer.
And most people wouldn't even know the name.
Steve Ballmer. Tell us about Steve Ballmer and why he's considered one of the greatest investors of all time, and what didn't he do as we talk about the uncertainty heading into the summer months.
Yeah, and it's funny. I listened to a podcast recently. It's the Acquired podcast. Those of you that like listen to podcasts, little shout out, little advertising for it's a really good podcast. I listen to it regularly. They really do deep dives into businesses, and they recently interviewed Steve Ballmer, who was one of the he wouldn't consider him you would not consider him a founder of Microsoft, but he was one of the first or early employees at Microsoft, and eventually became number two to Bill Gates, the number two in charge. And then when Bill Gates stepped aside, Steve Ballmer stepped in as CEO at Microsoft. And his tenure, and Bill Gates timed this perfectly. Bill Gates stepped down in 2000, which is kind of an interesting time to step down. That was
no kidding. Right
that
as
was
things were getting ready to burst.
I know that was the peak of the .com. I mean, right before things went crazy. And Steve Ballmer stepped in 2000, and he was CEO at Microsoft till 2014, and so he was number one or number two at Microsoft for a long period of time. The thing that makes these guys at the Acquired podcast said that Ballmer could be considered one of the greatest investors of all time. I thought, what? He's not an investor. But what makes him unique is he's the largest shareholder at Microsoft. I mean, he owns more shares of Microsoft than Bill Gates, the founder at Microsoft.
Who's
And the
sold
reason
yeah.
and Bill Gates has been selling Microsoft for decades. I mean, for years and years. He sells a little bit every year. Well, the difference is Steve Ballmer never sold, and Microsoft has been an incredible investment. And now he's the largest shareholder at Microsoft. And in fact, I mean, with Microsoft being the majority, he receives over $1 billion in dividends a year. And most of that's coming from Microsoft. He has other investments. In fact, he's the owner of the Clippers. He owns the Clippers. Really interesting guy, fun podcast to listen to. But Ballmer's, interesting guy.
The dude is nuts.
Yeah, he's funny.
but I want to back on a few things that you said. He gets $1 billion in dividends a year.
Yeah.
Microsoft. That's crazy. But he's considered one of the best investors by this specific podcast. And, because he gets his $1 billion of dividends. But you said something interesting. The reason he has that is because he never sold.
Yeah.
So here we are talking about selling when uncertainty comes, and you're talking about one of the greatest investors that's ever lived that never sold. What can we learn from Steve Ballmer besides he has sweaty armpits when he's running around?
And he likes to scream. He's loud. He's kind of a funny character. I think in fact, Ballmer talks about this in the podcast. He said somebody asked him, or he was talking to somebody at Microsoft, and they says you should, don't sell. And the reason why, and he kind of realized this, is Microsoft is a great asset. It was a great business, and he felt like that it would compound and grow over time. And so he says he just decided he wasn't going to sell, and that's what he did. And so really, he didn't really he's a great investor for doing nothing and just sitting on his hands and owning the stock, and that made him a great investor, even though he's not really, I would call him an active investor. He just made the decision to own Microsoft for a long period of time, and he's done extremely well.
It's interesting to think how difficult it is, but that had to be really difficult after a stock doubles, triples, quadruples. Like, can it keep going? But obviously it can. But that question, the psychology that we all fall into this trap, hey, I've doubled my money, I should just get out while it's good. And that's where he just said, no, I believe in the business. Who knows all what he said to himself in the podcast? Go listen to the podcast. But it takes a lot of discipline to not sell after something has gone up a significant amount.
I think as I look back over my investing career, I think one of the biggest mistakes made many mistakes, but one of the biggest mistakes I've made is selling a good business that continues to compound, and looking back and say, and I remember the logic. I'm thinking of actually a company, I'll tell you, it was a company called Yum Brands I bought back in the early 2000s. And I think my logic for selling it, I didn't sell all of it, but my logic for selling it was because it doubled or tripled in value. And so I sold it. Well, guess what happened? It ended up going up over 10x, 15x over the next, 15, 20 years. and I sold it, a lot of it, when it was doubled or tripled in value. And the reason why is just because I tripled my money. That's why I sold it. I
Yeah.
think you have to have a better reason than that.
Yeah,
I have a
and
really good reason.
I mean, it's funny that we talk, and we talk a lot to many clients all the time about, hey, there's always a reason to sell, right? To me, the biggest reason to sell for a position like Steve Ballmer's Microsoft, where you might have a business in your portfolio that's 30, 40, 50% of your portfolio. And if you can tolerate that, great. But if you have a hard time going to sleep because if that one business goes down 30, 40, 50%, and if you can't sleep because of that, okay, psychologically, maybe there's a reason to sell, right? Why be stressed out in life if you know, if you have plenty of money anyway, right? That might be the only reason.
Like Microsoft, great company. The stock has done really, really well. But obviously, you and I know .com bubble, and there were years regulatory and those types of things where Microsoft was dead money for a while, and so he had to ride that entire wave to be able to get what he ultimately has today. Any guesses, you guys? Microsoft's annualized rate of return since the IPO in '86?
Oh, it's thousands and thousands of
Well, no,
percent.
annualized,
Oh,
annualized.
annualized.
No.
I'm going to guess 40%. I don't know.
At least where I'm looking right now calculates it at 24%. That's just
Okay.
price. That's not dividends or dividend reinvestment, but just price appreciation.
No, that's crazy.
24% a
Yep.
year since '86. That's amazing.
Yep.
That is it. Yeah. And, interesting about Ballmer, he was the CEO. He took over in 2000. That was kind of the peak of the .com. Microsoft was selling at a very rich multiple, very rich valuation. And his tenure was really kind of noted that Microsoft stock did not do that well
No.
over that. I mean, it didn't make a lot of money. It probably made some. I don't have the data on that right now, but it didn't do that well. And it really, I think, goes to the point that, I think what happened is that the valuation contracted. The company still grew revenue and grew earnings over that time, but the valuation was so high back in 2000.
Yeah, that makes sense. Speaking of, he owns the Clippers. Who owns the Lakers now?
Yeah, so this is putting a bow on Steve Ballmer. Many reasons to sell. Doesn't mean you should. But his crosstown friends, the Lakers. This is a kind of an interesting story. Jerry Buss in 1979.
Dr. Jerry Buss. I don't know why he's called doctor. Yeah, I know, but they always call him Dr. Buss. I have no idea. He's not a doctor of anything, but Dr. Buss.
He doesn't have a doctorate degree of something?
I don't think so. Don't quote me on that, but
who knows what happened in the old Forum Club back in the days to get him that designation? I don't know. Don't want to know. But Jerry Buss bought the Lakers in 1979 for $67 million. They just announced, the Buss family, Dr. Buss has gone to the other side. And they just announced.
He did have a PhD, physical chemistry, PhD.
Yeah, I just Googled that too. Yeah.
I don't know. That's a whole other subject for another day. Do we call him doctor? Do we not?
He has a PhD.
I'd call him Dr. Buss.
His family just announced that they're selling the Los Angeles Lakers for $10 billion. Okay, so in 1979, bought for $67 million. Today, selling for $10 billion, which is an insane amount of money. Insane amount of money. Sounds like a fantastic return, which it is. It is a return annualized of 10.84%. That's good. Here's the interesting part, Spencer, and you're the basketball guy, so I want you to address this. Had they taken that $67.5 million in 1979 and said, you know what, forget this, don't want to deal with the Lakers, Showtime, Wilt,
Kareem,
Kareem,
Magic.
Magic, and dealing with LeBron lately. I don't want to deal with any of it. We're just gonna index it, and we're gonna put it in the S&P 500. The amount of money they would have now is 12.953 billion. So rounding up 50 million, they'd have $13 billion compared to their 10 billion. Had they just put it in the market and turned on the drip, the dividend reinvestment, and just kept it in. That's crazy. Spencer, what do you think? You're the basketball guy here.
Yeah, that's so I messaged you guys yesterday about it, when the news came out. Was it yesterday, the day before? And thought, man, what an amazing return. Professional sports franchises have really inflated over the last decade, right? Really inflated. But I then just had the thought, it's so funny when you deal with private investments. A lot of times big numbers are thrown out, multiples, and it feels like they have so many acronyms in different in this industry. But I just was like, I wonder what that is annualized. What's that rate of return annualized? And so I got on, I annualized it, and I honestly thought, now IGGA didn't start in 79, we started in 99, but I thought 10.64% is good, really good, really good.
Yeah.
But
Yeah.
but at the same time, you're like, what it is it's time and it's compounding interest. And the thought process behind, obviously they pulled money out of the business, so we're not getting total return for them, 67 to 10 billion. Who knows how many millions, maybe even $1 billion they pulled out of the business. I have no idea how much they pulled out over that time period.
They could have mortgaged some against the business too, to
Yeah.
where it may end up with 8 billion instead of 10. You just don't.
Yeah. But regardless, it just shows how attractive public markets are. Like owning a sports franchise, a lot of people would think that's awesome, and obviously they're with smoking cigars with Magic or doing whatever, and a cool lifestyle things, getting to talk to Jack Nicholson and in LA, yada 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 yada. But from a returns financial standpoint, how much work? That's the other thing,
Yeah.
the
Yeah.
amount of work that goes into it, to where you just realize liquidity and owning great businesses can produce unbelievable returns, and that's just evidence of it, right? That's great evidence of it.
So I want to go back to something you just said, okay? Because we're talking about total return. It's better in the public markets, okay? And I'm going to pause there because then I want to get to your liquidity comment here in a second. But why, when you're talking professional sports team, like in this case, when you're talking real estate, when you're talking, venture capital, you're talking private equity, all this stuff, like why are those investments so sexy, but the public markets are like, eh?
Yeah,
When they have better returns than everything.
Yeah, I think probably two parts of it, and we've talked a little bit about this before. I think exclusivity, matters, and then also,
What does that mean?
well, you can't have $200 and go get in a private equity deal. You could have $200, open up a Robinhood account and buy a share of Nvidia, right? You can do that. And so exclusivity is attractive to certain investors. And I think this is the other part of it as well. Daily pricing scares the bejeebies out of people. It just scares the bejeebies. The Lakers, like, man, they don't look every 5 minutes at what they're worth, right? They don't, I mean, once a year there's some type of valuation, or Forbes comes out with an article with what sports teams are valued at, and yada yada yada. But a lot of people hate daily pricing and the movement of the markets. And so they love the idea. Yeah, I own a private business. I'm involved in a private equity fund. And I don't get daily pricing. I get quarterly updates, and they use all these acronyms and different percentages. But at the end of the day, I don't have to, in their mind, they don't have to worry about it. So I think the exclusivity matters to people. And then
people want to feel special. They
for
want
sure.
their salesman to take them golfing all the time. They want that exclusivity, rich person's club, even though the returns are not as good as the public
Yeah,
market.
and
They want
people
that exclusivity.
people watching this podcast will say, well, I was involved in a private equity fund and I got a 5 times return over 10 years. For sure, there's individual private equity funds that had crazy returns for sure. But as an asset, but there's individual stocks, like we just talked about Microsoft, that have had crazy returns. But if you
Yeah.
look at the asset class in general, public equities, private stock, or private equity, venture capital, I mean, public equities perform really, really well over those time periods. I mean, you can go 20 years, you can go 50 years, you can, do whatever, and they do really, really well. And so,
Yeah.
um,
And you
I think
compare, I'll go ahead.
I just think daily pricing scares a lot of people. I used to think exclusivity, and also it's a great pitch, and people hear, oh, that guy's in private equity, I want to get in private equity, endowments were really getting into private equity, yada yada, all that kind of stuff. But and so there is part of that, like you said, kind of the rich kids club for sure. Um, but I think more of it, Brett, honestly, I think it's daily pricing. That's what I think people want to
Which
go that they can't handle.
is its
Strength.
greatest thing.
Yeah, because that's what
Uh,
creates the opportunity.
At least one of them. Yep, that's where the opportunities lie. And if you compare Iron Gate since inception to even the S&P 500, and you look at what we do now with options and everything else, it's like,
Yeah. Yeah.
forget we are
Pretty good, man.
exclusivity.
Pretty good.
Well, and
Would be.
also in terms of the businesses in the S&P 500 or in the US, really, they are the best businesses in the world. There's no doubt, and so yeah, you can invest in the Lakers. I'm not saying the Lakers is not. I mean, Lakers owning an NBA franchise or NFL franchise, or I mean, those are pretty good businesses because there's not a lot of supply. I mean, there's just so many
And there's
teams.
competitive advantages, and you've got, I mean, yeah, all
Those
of
are good
them
businesses.
make it.
I mean, yeah, those are good businesses. But really, I mean, the best businesses in the world are right here in the U.S.
Yeah.
The S&P 5. I mean, you can just list them right down the S&P 500, the top 10 or 15, 20 companies. Yes, they're the best business in the world. I mean, there might be a couple private companies in the world that maybe make that list, one or two. I mean, very
Are
few.
there
Yeah.
Are there any? It'll be interesting if any professional sports franchises go public, and you may be able to answer this,
Green
Brent.
Bay Packers.
Yeah, I was going to say the Packers have a
I think the Braves are too.
Yeah, Atlanta Braves are too. So what's interesting, and I'm going to go back to something you said, Spencer, but I'm going to go even further back to a podcast we did probably a year ago when the NFL owners said, hey, we're going to sell up to 10%, I believe it was 10% of our franchise to private equity because we need liquidity. That goes to the liquidity comment. Spencer, you do financial planning with this more people than Brian and I. Talk about liquidity.
It's funny. I was talking to a friend of mine before doing this broadcast. He starts businesses and does a great job of building them up and then selling them to private equity or venture capital firms. He's got a great track record of it. And we were just talking about everyone undervalues liquidity. I mean, everyone does.
100%.
There is a premium that should be put on liquidity. And if you're not going to be in a liquid investment like a public equity, you better be getting in excess of the returns you could get of those public equities to justify that lack of liquidity.
Yeah.
Private equity fund, 5, 8, 10 years. And I mean, I don't know if you guys have seen a lot of the endowments. There's higher education endowments that are trying to sell on the secondary market. They got so heavily weighted in illiquid investments in private equity specifically. Now they're trying to go to the secondary market, and they're going to have to take a haircut on those investments. And I don't know if a loss, but they'll take a lot. They'll sell it at a discount to what it is currently worth to try to liquidate it, just because they've been in it so long. Interest rates have gone up, and so it's really hard for private equity funds to exit investments right now. And so the liquidity of public markets, yeah, the price you pay for that is the volatility, right? That's the price you pay to get daily liquidity. But man,
It's worth its weight.
that's I think it's
Yep.
well worth its weight to
I think
be
it's
able to
funny.
get your money. I mean, Brett, we had a call us last night, say this morning, hey, I need this money to buy a car, and what they're gonna have they're gonna have their money in 3 days, right? And bam,
Yep.
just like that.
It's
Yep.
funny that, you know, the knock on public equities is daily pricing, but yet it also, the flip side of that is liquidity.
Yeah, that's his strength. Yeah,
And opportunity. Yeah.
Well, and it's what you talked about in the sense if you don't have a problem, you'll find one. I mean, you're looking at what we view as the greatest strength. Someone else looks at it as the greatest weakness of the public equity markets. But I think the daily pricing and the liquidity, that's the greatest strength of the public markets.
Yeah.
You mentioned these endowment funds. Harvard's probably the biggest example of this right now, as they are under attack by the administration, right? For many, many reasons. And now they have this huge endowment, which is heavy into these illiquid VC investments, private equity investments. Now they're having to go in and price those, and there's a 20-30% haircut on what they thought they were worth, because now they have to sell them because they need the liquidity.
Yeah.
So a lack of liquidity now cuts the return, forces you out. I mean,
I've said it many, many times, so I apologize to our listeners, but a large majority of crises, whether at the macro, at the country, at the corporate, or at the household level, don't occur because people own bad assets. Silicon Valley Bank did not go under because it owned bad assets. It went under because it didn't have liquidity. And that's the same for Greece. That's the same for not all, like what was the fraudulent one? Oil company. I mean, there's
Enron.
Enron.
Yeah.
Like that's a whole different thing. But most crises occur not because of bad assets. It occurs because of a lack of liquidity.
And that's why Berkshire, along those lines, Buffett's always said that he'll always have $30 billion liquid, always at, just the tip of his fingers.
Is it Brian? Is that why you always have 30 billion liquid as well? You just
lying around.
Just take a lot of zeros off of there. Take a lot of zeros off.
It's funny when we talk about returns, Spencer. I heard a famous billionaire say, if I get 10% from the stock market, which is liquid, I better be getting in an illiquid investment 20% minimum to make up for the illiquidity, right? And so you talk about returns above in these
that's the liquidity.
liquid.
That's
Yep.
what I talked about. In a
Yep.
private equity fund, you have to have a liquidity premium. And 10%, I mean, that's pretty aggressive, to be honest with you. I know who you're talking about. I think that's aggressive. But for sure, you've got to be getting 3, 4, 5% more. 3%. Aswath Damodaran, the valuation guy, he's done some stuff on this. What is the liquidity premium? It's got to be something, right? And when you look at private equity over, depending on the time frame, and I can't remember, over the last 20 years, 40 years, whatever it was, when public assets and public equities outperform it, you're like, man, illiquid and underperformance, that doesn't seem like a great investment.
Yeah.
No, and when there's a forced liquidation, you're probably thinking, man, I wish I would have gone for that 10% difference instead of that 3 to 4% difference. Like
Yeah.
Harvard right now, but
Right.
yeah.
It's interesting. I mean, and that's not just Harvard. That higher education from 2015 to 2022, I don't know. I mean, especially 2015 to 2020, so many of those endowments, private equity was so sexy and they were going overweight private equity. Well, part of the problem is that fund that opened in 2016 or 2017 should be maturing now. And the interest rates are in a place where they can't. So it's
Yeah.
like, okay, well, what are we going to do? And that's where liquidity for Harvard comes in.
Yeah, interesting topics. We were going to talk about what is wealth. Let's save that for next podcast. We've talked about Steve Ballmer, the craziest CEO. If you want to see a funny video, type in Steve Ballmer dancing in YouTube, and there's that video of him and Bill Gates dancing. The greatest investor. Why? Because he didn't sell. Not that everyone should not sell at some point, right? But interesting. And then the Lakers versus the S&P 500 liquidity and many other things. Thanks, guys, for a good conversation today.
Hey, thanks for the invitation. I'll just be here. If you ever need me again. If you want to call me tomorrow and do another one.
Ryan, you and I are going to do great the next couple months. Spencer, we'll.
Hey, I like the three of us. A little bit of banter back and forth. It's good.
I'll see if I can fit you guys in.
All right, appreciate that. Have a good weekend, fellas. Until next time. Bye now.
See you.
This is a purely public broadcast and is not intended to be personalized financial advice for any individual's specific situation. Each individual's financial situation is unique, and the topics discussed on this broadcast should not be relied upon and/or considered as personalized advice. Specific financial securities discussed are not intended to address any listener's particular financial situation and should not be considered recommendations. This is for educational purposes only. For more information, please contact Iron Gate Global Advisors at info@igga.com or by calling 888-591-0334.